In today's global economy, a strange paradox is unfolding. Corporations are sitting on mountains of cash, more than ever before. Yet, instead of investing this capital to build, expand, and innovate, they're holding back. This is the great investment enigma of our time. It's not that there aren't opportunities, it's that the future feels incredibly uncertain. So why are the traditional engines of our economy idling? Let's decode this private sector hesitancy and explore what it might take to unlock this dormant capital. At its heart, making an investment is an act of faith in the future. It's a bet that tomorrow's returns will be worth today's risk. But when the future is shrouded in fog, faith turns to fear and action grinds to a halt. The current wave of investment hesitancy isn't caused by one single thing, but by a perfect storm of factors making the future more opaque than ever. Let's start with the first major deterrent: economic and policy uncertainty. Think of a business leader as a ship captain. To navigate, they need clear maps and steady stars. But right now, the economic seas are incredibly choppy, and the policy stars keep shifting. The safest choice often feels like staying in port. The global economy has given us all whiplash. We went from a global pandemic to soaring inflation, followed by central banks aggressively hiking interest rates to cool things down. This volatility makes it extremely difficult for a business to forecast future demand and profits. When interest rates are low, borrowing is cheap, which encourages businesses to invest. But when central banks raise rates to fight inflation, the cost of capital goes up, and that investment enthusiasm quickly fades. Imagine a company thinking about building a new factory. Suddenly, they have to worry about the rising cost of borrowing money for the project. But they also have to wonder if customers will still be able to afford their products in a world with higher prices and a potential recession. This is especially true for industries like manufacturing and construction, where investments are huge and take years to pay off. On top of the economic uncertainty, there's the unpredictability of government policy. Frequent, unexpected changes in taxes, regulations, and trade rules can completely derail a company's business plan. Take trade policy, for instance. The rise of protectionism and tariffs, like those seen in the trade tensions between the United States and China, has sent shockwaves through global supply chains. Companies have been forced to rethink where they build their products and where they get their parts. The constant uncertainty about which goods will be taxed and by how much puts a chilling effect on new investment. This uncertainty has even slowed down deal-making in private equity, as firms find it difficult to value companies whose supply chains could be disrupted at any moment. Then there are regulatory riddles. The possibility of new rules around environmental protection, data privacy, or labor laws can lead to investment paralysis. While these regulations are often for a good cause, the uncertainty about what the final rules will look like and how they'll be enforced can cause businesses to simply wait. This wait-and-see approach can stifle innovation and drag down economic growth. Finally, there's the maze of fiscal and monetary policy. If a company thinks corporate taxes might go up, the potential return on a new investment looks less attractive. If they can't predict the future path of interest rates, they can't accurately calculate their cost of capital, a crucial number for any investment decision. For example, in the United States, the scheduled expiration of certain tax cuts creates a fog of uncertainty for businesses trying to make long-term plans. The second major factor is geopolitics. In our connected world, a crisis in one region can have a massive impact on businesses everywhere. Geopolitical risk is no longer a niche concern. It's a major topic in every boardroom. International conflicts, like the war in Ukraine or tensions in the Middle East, have direct, tangible effects. They disrupt supply chains by blocking shipping lanes or destroying infrastructure. They cause energy and commodity prices to spike, squeezing profit margins. And they pose a direct risk to a company's physical assets and the safety of their employees. A recent survey showed that a staggering 83% of global executives see geopolitical and economic uncertainty as a barrier to growth. Many are now reevaluating their investment policies and the security of their operations abroad. For companies looking to invest in emerging markets, political instability is an even bigger deterrent. The risk of a government seizing private property, combined with corruption and a weak rule of law, creates what's known as an instability premium. This means companies will either demand a much higher potential return to justify the risk, or they will simply avoid investing in that country altogether. This is especially damaging for developing nations that depend on foreign direct investment to grow their economies and create jobs. In response to all this risk, we're seeing a realignment of global supply chains. Companies are increasingly moving production closer to home, a process called reshoring, or to politically stable allied countries, known as friendshoring. While this makes supply chains more resilient, it also requires enormous new investments in factories and infrastructure. The hesitation to commit to these huge projects, given the uncertain future of global trade, is yet another facet of the investment enigma. The final piece of the puzzle is the double-edged sword of technology. The relentless pace of technological change and the saturation of key markets are creating their own unique uncertainties. The economist Joseph Schumpeter famously coined the term creative destruction. This is the process where new innovations destroy old industries while creating new ones. Today, we are living through a powerful wave of creative destruction driven by artificial intelligence, automation, and digitalization. This technological revolution presents a classic dilemma for businesses. On one hand, investing in these new technologies can lead to massive gains in productivity and competitiveness. AI, for example, can optimize supply chains and create personalized customer experiences. On the other hand, the rapid pace of change creates huge uncertainty. Companies worry about betting on the wrong technology. They fear investing millions in a new system only to see it become obsolete in a few short years. This fear of being on the destructed side of creative destruction can lead to paralysis. Companies are afraid to invest in the old, but they're also afraid to make the wrong choice with the new. We see this clearly in the auto industry, where the shift to electric vehicles requires monumental investment with a still uncertain payoff. At the same time, in many developed economies, key markets are reaching saturation. Think of the smartphone market. Pretty much everyone who wants one already has one. In a mature market like this, opportunities for organic growth are limited. Competition becomes a zero-sum game of stealing market share from rivals. This discourages large-scale investment in new production capacity. Instead, companies might focus on smaller, incremental improvements, marketing, or cost-cutting. While these are valid business strategies, they don't have the same powerful, economy-wide impact as building a new factory or developing a breakthrough technology. So, the situation seems complex. But while the forces driving this hesitancy are formidable, they are not insurmountable. Let's now turn to the solutions and explore how we might unlock those corporate coffers. The first step involves governments. They have a critical role to play in cultivating a climate of confidence. More than any specific tax break, what businesses crave most is stability and predictability. This means creating clear and consistent legal and regulatory frameworks, upholding the rule of law, and avoiding sudden, arbitrary policy shifts. When businesses can trust that the rules of the game won't change overnight, they are far more likely to make those crucial long-term investments. Beyond stability, governments can use smart incentives to encourage investment in specific areas. Tax incentives are a powerful tool. This could mean tax credits for research and development, for investments in green technology, or for creating jobs in certain regions. For example, California offers a California Competes tax credit to businesses that choose to relocate, stay, or grow within the state. Another tool is direct financial support. Grants, especially for small and medium-sized enterprises or highly innovative projects, can help de-risk investments and spur entrepreneurship. The U.S. Small Business Administration's Small Business Innovation Research Program is a great example of this, providing seed funding for new technologies. Governments can also help mitigate risk through loan guarantees or political risk insurance. This is particularly important for encouraging investment in emerging markets or in new, unproven technologies where the risk is highest. A powerful model for mobilizing private capital is the public-private partnership, or PPP. This is where a government partners with a private company to design, build, finance, and operate a large-scale infrastructure project, like a new airport or power plant. The benefits are numerous. First, it allows for risk sharing. Risks like construction cost overruns can be transferred to the private sector, which is often better equipped to manage them. Second, it provides access to private sector expertise and efficiency. And third, it taps into private sources of funding, freeing up public money for other priorities like education or healthcare. By creating a clear framework for these partnerships, governments can attract significant private investment in critical infrastructure, which in turn makes the entire country a more attractive place to invest. But it's not all up to the government. Businesses are not just passive victims of uncertainty. They can adopt more agile and resilient strategies to navigate this turbulent environment. In an era of constant change, the ability to adapt is everything. This means diversifying supply chains, customer bases, and product lines to reduce exposure to any single point of failure. It also means using tools like scenario planning and stress testing. By gaming out potential shocks, from a new trade tariff to a spike in energy prices, companies can develop contingency plans and be better prepared to respond when a crisis does hit. This is a shift from focusing only on cost-cutting to actively investing in resilience. This could mean using digital tools for better supply chain visibility, building up strategic inventories of critical parts, or investing in more flexible manufacturing processes. And instead of viewing technology as a threat, businesses should embrace it as a powerful tool for navigating uncertainty. Investments in AI, automation, and data analytics can help companies improve their forecasting and decision-making. Automation can streamline operations and free up employees for more creative tasks. Technology can open up entirely new markets for companies willing to innovate. In conclusion, the investment Enigma is not some unsolvable riddle. It's a rational response from businesses to a world that feels increasingly unpredictable. The hesitation to deploy trillions of dollars in capital is a clear signal that the old assumptions about a stable global order are gone. But within this challenge lies an enormous opportunity. By understanding the deep-seated causes of this hesitancy, the economic and policy fog, the tremors of geopolitical risk, and the disruptive force of technology, we can forge a new path forward. There is no magic bullet. Unlocking the private sector's investment potential requires a concerted effort. Governments must focus on creating a climate of confidence through stable policies and smart incentives. Businesses must embrace agility and resilience, investing not just in new machines, but in their ability to adapt. The capital is there. The opportunities, from the green energy transition to the AI revolution, are immense. By working together to decode the investment enigma, we can unleash a new wave of private investment that will not only drive economic growth, but help build a more prosperous and resilient future for everyone.